At the 37th OPEC and non-OPEC Ministerial Meeting in Riyadh, Saudi Arabia, the OPEC Plus alliance, which consists of two of the top three oil-producing nations in the world, Saudi Arabia and Russia, met. The group extended oil production levels to the end of 2025 and reiterated their commitment to the Declaration of Cooperation, DOC. They will still base their 2026 production levels on unbiased sources. The decision progressively lessens some cutbacks beginning in October 2024, even as it extends the voluntary output cuts of 2.2 million BPD announced last November into the following year. This move, which aims to balance market needs and stabilize oil prices, is indicative of Saudi Arabia's efforts to balance the interests of its different member countries. The partnership will keep an eye on market conditions and modify its plans as necessary. Notably, after protracted discussions, the UAE will see a roughly 10% increase in its production objective for the upcoming year. The Joint Ministerial Monitoring Committee, JMMC, has the power to summon extra meetings if needed and will convene every 2 months to evaluate market conditions and compliance. The necessity of fully adhering to output agreements was underlined, and December 1, 2024, has been set aside for the next OPEC and non-OPEC Ministerial Meeting. Even though the world's crude supply was over 6% less due to OPEC Plus restrictions and tensions in the Middle East, oil prices have decreased by almost 10% since they peaked in early April. The world benchmark for crude oil, Brent, decreased from $91 in April to $82 per barrel, while West Texas Intermediate, WTI, fell from about $87 to $78. The International Monetary Fund estimates that Saudi Arabia's budget must balance at roughly $81 per barrel for Brent crude. But because of the continuous increase in U.S. crude output, OPEC has found it more and more difficult to keep prices under control. Bhushan Buri, executive director of Sant Global Commodity Insights, stated in a news release, "This time 2 years ago, OPEC Plus output was 2.2 million barrels per day more than it is presently. Crude oil output outside of OPEC Plus has increased by 3.1 million barrels, with the United States accounting for almost half of this expansion." In other words, OPEC Plus has to allow space for other producers to increase their supply or risk seeing their prices decline. The monthly Reuters survey released on Tuesday indicates that OPEC's oil production increased in June for the second consecutive month due to higher output in Iran and Nigeria. The report, which monitors supply to the market and is based on data from industry sources and shipping data, revealed that all 12 of OPEC's producers pumped 26.7 million barrels per day, BPD, of crude oil in June, an increase of 70,000 BPD from May. Nigeria, the largest oil producer in Africa, raised its output last month by an estimated 50,000 barrels per day. This comes after years of underperformance in the OPEC Plus agreement, which resulted in the OPEC Plus group reducing its quota at the end of last year. According to Reuters monthly surveys, Iran, which is not included in the OPEC Plus pact, recorded an increase in oil output to 3.2 million BPD in June, which matched the country's previous 5-year high from November 2023. According to a recent Reuters survey, the sharpest reduction in output occurred in Iraq, the second largest producer in OPEC, where production was lowered by 50,000 barrels per day. Iraq did, however, continue to surpass its OPEC Plus limit last month. OPEC as a whole produced 280,000 barrels of oil per day more than its 9 members who were required to by the agreement. According to the Reuters survey, Iraq's surplus production remained the greatest quantities exceeding the OPEC Plus objectives. As the OPEC Plus group prepared for the pivotal August meeting to determine output policy for the remainder of the year, May saw a 29,000 BPD increase in crude oil production over April. According to secondary sources cited in OPEC's monthly oil market report, which was released in June, the average total crude oil output of all 12 OPEC members in May 2024 was 26.63 million BPD, an increase of 29,000 BPD from April. According to OPEC's secondary sources, Iraq, which has failed to adhere to its 4 million BPD production cap, produced 4.195 million BPD in May, down 7,000 BPD from April but nearly 200,000 BPD above its objective. Since the end of 2022, oil prices have been trading in a narrow range of $75 to $90 per barrel as the OPEC Plus group keeps supplies off the market, but persistent worries about the world's oil consumption have tempered optimistic mood. According to LSEG statistics quoted by Reuters on Friday, Brent crude prices have fluctuated between $75 and $90 per barrel since the end of 2022, after surging to above $100 a barrel during the Russian invasion of Ukraine in early 2022. With its ongoing strategy of keeping some supply out of the market, the OPEC Plus alliance is keeping a floor under oil prices, but traders have been reassured that the group could manage a sudden disruption in production due to the higher spare capacity of its members. Even after a second conflict broke out in 2023, in the Middle East, no less, the higher spare capacity has managed to keep prices in check. For the past 20 months, OPEC Plus has mainly been successful in maintaining oil prices in the region of about $80 per barrel. When prices fell in the $70 for extended periods of time, it proceeded to take more drastic measures. However, since the end of 2022, prices have not approached the triple digits. This is mainly because of worries about the state of the world economy, rising interest rates, and the lackluster demand for oil in China, the country that imports the most crude oil worldwide. Norbert Rooker, an analyst at Julius Baer, told Reuters that we see a well-supplied oil market today with a rather pronounced stagnation of demand in the Western world and China. The OPEC Plus oil production policy remains the primary determinant of the health of the oil markets, according to ING earlier this week. According to ING, oil prices will peak in the third quarter and then begin a downward trend that will last until the end of the year and into 2025. According to their prediction, the price of Brent crude would reach $88 per barrel in the third quarter of 2024 and then fall to $80 per barrel for the entire year. The primary danger to this prediction is that the market shortfall might last until 2025 if OPEC Plus chooses to keep cutting at its current rate. For the past 4 weeks, oil prices have been rising, but the rise has been erratic and sluggish, and it hasn't persuaded markets that the trend is stable. Traders are beginning to seize the chance, albeit others are hesitant, as the positive indicators for oil continue to grow. This week, Bloomberg revealed that, due to forecasts of higher demand for petroleum in the second half of the year, speculators have been increasing their long positions in the commodity, with the net amount reaching around 196,000 lots this week. In fact, the first half has not lived up to analyst forecasts, particularly in China where imports have lagged. However, some analysts predict that oil consumption will be stronger in the second half of the year, particularly in the US, where driving season is at its height and demand is showing some positive signals. According to the AAA, this year's July 4th weekend saw record levels of travel, particularly for cars. Summertime temperatures are now helping oil prices. However, as Reuters notes, Gulf Coast refiners may face difficulties as high temperatures can cause equipment damage and malfunctions. Naturally, all of this is dependent on frequently varying projections and ignores any black swan events, such as erratic weather during hurricane season. Up to 7 significant hurricanes are predicted for this year. However, it is important to remember that last year's projection was also very dire, yet it never came to pass, with a relatively poor hurricane season overall. Apart from the aforementioned regional and seasonal variables, it appears that the ongoing conflict in the Middle East is also a source of motivation for oil bulls. There is still a chance of an oil supply disruption in the major exporting region, which might have a variable impact on daily price fluctuations, despite many attempts by mediators to achieve some sort of truce. On the whole, nevertheless, the prospect of increased oil demand in the second half of the year is the primary driver of the comeback to bullishness. It might be predicated on the lower than expected level of crude imports from China, with the hope that the first half of import data did not predict import patterns for the second half. However, Bloomberg reports that the number of tankers headed for Chinese ports has dropped to the lowest level in 2 years, which may temper these hopes. The journal revealed earlier this month that, during the next 3 months, only 86 tankers had named China as their destination, down from 5 during the first week of July. Though it is important to note that Bloomberg also revealed in April that the quantity of tankers headed for China had increased to its highest level in a year, this did not assist actual imports in the first half meet analyst projections. A gloomy indication for oil traders would be OPEC Plus starting to increase production this year, as some seem to be expecting. However, it's important to remember that OPEC Plus stated that production growth will only occur if the market conditions are right. Some analysts have predicted a shortage since the market conditions do not seem to be favorable for any rollbacks in the production limits that have kept OPEC Plus supplies under wraps. This is because, despite China's weak demand worldwide is strong. A major contributing factor in this is the essentially Red Sea Houthi blockade, which has compelled ships to circumvent Africa in order to take the lengthier voyage between Europe and Asia. This has increased the world's oil demand by about 100,000 barrels per day, as estimated by Vitol back in March. The possibility of underestimating the strength of demand outside of China is another factor. Asia's overall oil demand increased by 5% last year, somewhat offsetting slight decreases in Europe and the United States. This year appears to be no different, unless, of course, growing costs become a barrier to purchase. In other words, nothing much is changing in the cyclical oil sector.